Chapter 13, Learning Objective 2, Identify your investment philosophy and invest accordingly. The book as it acts as if these investment philosophies are independent of each other. I don't believe that they are. I think you can adopt more than one of these, and I think it's wise to adopt more than one of these. So first thing to think about is how to handle investment risk. We've got different types of risk. We've got speculative risk and pure risk. The pure risk involves in situations where the uncertainty pertains to the potential for a loss. Now, these are insurable situations. Speculative risk involves situations where there's a potential for gain or loss, which is the case when we invest. So, investment risk is speculative risk. There's a lot of different types of risk associated with investing, and we'll talk about those as we move forward. Investors demand a risk premium. The risk on a T-bill is nearly zero, and as a result, the rate of return is near zero as well. When we compared T-bills to the rate of inflation, and there was almost no difference between the two. People demand a risk premium to take that risk associated with riskier investments. It just can make sense. If you're going to take risk, you should expect a higher rate of return. The next slide, Figure 13.2, is what they call the risk pyramid. It goes from the bottom where you have savings in bonds and CDs and treasury securities, the least risky, all the way up through, you have blue chip stocks in the middle there, partnerships and options and junk bonds and speculative stocks and options and future contracts and so forth, and you can accept risk accordingly. One thing to know about futures contracts and options, most options and most future contracts expire worthless. The reason being they're written by people who know what they're doing, and they're only willing to sell contracts where they know that they're likely to make money. Be leery of investing in anywhere where the person you're investing with knows more than you do. So, what type of investor are you? What is your investment philosophy? Are you conservative? Are you concerned about preservation of capital? Preservation of capital becomes more and more important as we age. A 60-year-old should not be investing in the same types of investments as a 25-year-old. It just makes sense. You're closer to retirement, you can't afford to accept that risk. That's preservation of capital. Moderate investor, you accept some risk as a part of investing, but you're not willing to go all out. Aggressive investors are, risk seekers. An aggressive investor probably, would be likely to invest in all stocks. They would probably invest a lot in technology and so forth, in stocks that would, generate very high rates of return. So, next, should you take an active or passive approach? Most people think of investing, they think of active investing. The truth of the matter is that historically, passive investing, which is investing in fixed portfolios, index portfolios, and so forth, have outperformed active investing. The difference is significant since the most recent financial crisis. some people think that this is a function of so many people investing in 401ks, which for most 401ks don't allow for active investing. They only have passive investing options. You know, active investors, trading, you're looking for value and so forth. There's some theory that a lot of theories that basically say that active investing is a waste of time. The truth is, active investing is probably a waste of time for you and me and most people, just because we're not sophisticated enough to identify where that value is. Active investors think that markets are inefficient. For the most part, or for you and me, they are certainly efficient. Are there inefficiencies? Yes. But the question is, are you able to identify those inefficiencies? It's very difficult, and very few people are. Very few money managers. 1 in 5 money managers consistently outperform the market. Passive investors are buy and hold investors. The idea of passive investing is that what you're trying to do is achieve the market rate of return. So the next question is, do you want to lend or own? Lending is equivalent to buying bonds. Fixed maturity, fixed income. Owning means buying equities. We've talked about this a little bit. In the current market, investing, you need to be very cautious investing in bonds because of what the actions the Fed is taking towards interest rates. It is likely that fixed interest rates and fixed income rates are likely to climb, which will cause a reduction in the value of bonds. Next, you're going to make short, intermediate, or long-term investments. Truthfully, if you're saving for retirement, you should be making long-term investments. You don't want to be concerned with the short and intermediate term. Set that money aside and invest it. You want to look at your portfolio every once in a while and rebalance when you need to, but you don't want to have too much concern with short, intermediate term. When you're investing in your 401k on a monthly basis, you're doing what's called dollar cost averaging, and so as a result of that, your investments, the cost of your investments will be based on an average of what you put in every month. You choose investments for the components of their return, capital gains versus current income, and so forth. Concept check 13.2. Summarize your investment philosophy and general approach to tolerance for risk. You've got to be willing to take some risk, and I highly recommend you think about a passive investment strategy. In addition, you don't need to hire a professional to do so. Indicate whether you view yourself as a passive or active investor. It's unless you've got a whole lot of time to spend and you're more sophisticated than the rest of us, you should likely be a passive investor. So pretty much covered that. So next, which type of investment return or capital gains seems more attractive to you? Capital gains are usually preferred by younger investors because they are saving for the future. Apologize for the typo there. Current income is usually preferred by retiring investors because they don't have the income that they used to have from working. So summarize your personal views on lending and owning investment. the you know, lending involves buying bonds, which I mentioned has a considerable amount of risk at this point in time. You know, for the most part, if you're going to invest right now, I would invest. If you're in any bonds, I would invest very short term, and put the rest in equities. Which type of return, current income or capital gains, seems more attractive to you, and why? Capital gains, because I'm saving for the future. Tax rates are lower on capital gains. I don't. Also, I can, if I can invest on a tax-deferred basis, I'd prefer those as opposed to current income, because current income means that I have to reinvest, which also involves risk.